Hello ladies and gentlemen, this is Nathan from my crypto paradise. In this video we will be going through one of the most popular indicator used by traders all over the world. This is the moving average. We'll give you a lot of information such as how to use moving averages in trending market, how to use them in the range market, and specifically how to use the MACD, which is an indicator directly related to the moving averages. Finally, we will go through the types of moving averages, the most popular values for the moving averages, and the ways to use them as the support and resistance indicator. So get yourself a nice drink and let's get started. To start with, let's begin with the type of moving averages. The most popular ones: simple, which is white, exponential, which is yellow, weighted, which is blue, and smooth, which is red. Each and every of them represents an average price during the certain periods of bars back. On this chart, all the moving averages are in period of 50, which means that in order to calculate the value of, let's say, a simple moving average at this spot, we need to take 50 bars back, and based on this price action, we'll have the value right there printed on the chart, which is near $55,000. But you might ask, if this is an average price, why they're so different? This is because they use slightly different formulas, although in essence, this is an average price of the certain periods of bars back, which straight away brings us to conclusion that this is a lagging indicator because it uses the price action from the past. But you might want to ask how to use them if this is a lagging indicator. Well, there are different ways and very unique ways of using it. But before we jump into that, just a quick look at a simple moving average with the different values. We have 5 moving averages on this chart, which is 9 period, 20 period, 50 period, 100 period, and 200 period moving average. These are the most common levels used by traders: 9, 20, 50, 100, and 200. Sometimes traders use different values such as 16, 11. These are also very popular ones. And the one you want to use is up to you. It depends on the strategy you found that working for you. And speaking about the strategies, just wanted to share this approach which many of you might find very useful for trading cryptocurrencies and other markets. So right there we have simple, exponential, weighted, and smooth moving average with a period of 50 in blue color. And we have only one 200 period moving average, which is the simple one. As you can see, one of the blue moving averages is in bold. This is for a reason, because the smooth moving average is the fastest of them all. Just to explain what is the fast and slow moving average, basically the moving average with a lower value, or the one that is reflecting the price action faster, called a fast moving average, while the slow moving average is either with a higher value or the one which reflects the price action in the slowest way, such as 200 period moving average. Now, as we got through that, what we can see on this chart, in many cases, the price went down and closed below all the moving averages, specifically smooth moving average. It has been on one occasion, then we had another one, then another one, and another one. This is all on the Bitcoin price action. And what it goes to show, that after price did close below, not just touched, but closed below, while staying above the 200 period moving average, it reversed back and continued with the major trend. It might not always work, so the confirmation for that could be the break above the previously made high or low in case of a downtrend. So these breakouts really show that the trend is continuing. Right there we did not have a closing price above. This is the daily chart here as well, but finally we had the breakout, price went down, retested the support, and went up once again. And this has occurred multiple times. We had another one, and another one, and we also had it right there. But if trading this way on the higher time frame, obviously there won't be many cases. You will find them once in 2 months or so. The lower time frame is always can be used to find these trading opportunities with a moving average. On this chart we looked how to use it in trending market because we are looking at the 200 moving average, which indicates the trend. But what if price continues to cross either above or below moving averages non-stop? First off, let me explain what we have on this chart. There is a fast moving average with a period of 20 and the slow moving average with a period of 50. At the same time, we have the MACD oscillator plotted on this chart with a period of 20 and 50, basically reflecting our moving averages. So just to show you the MACD settings, it's a simple moving average with a period 20 and 50, same as we have plotted on this chart. To explain you what is the MACD is basically subtraction between moving averages. And it goes to show you where we have these crosses, like when fast moving average crosses above the slow or vice versa. The MACD indicates that information as well. Like we had that cross right there, and we can see that MACD went above the 0 line, and right there we had a cross below where the MACD went below the 0. And this indicator can be very useful in the range market when the market is consolidating without a clear direction. Obviously, to distinguish the trend, even slower moving averages and higher time frames are used, such as daily chart and 200 period moving average. But when you start to see these crosses often, it means there is no trend and it's time to look for the range trade opportunities. And these opportunities can be found with a bullish or bearish divergence. The divergence itself means that when one moving average diverge from another, so basically they go away from each other, this is a divergence. But when they're going back closer to each other, this means convergence. And this is exactly why this indicator called MACD, because the abbreviation means moving average convergence divergence. So this indicator shows us when we have the crosses, show us the subtracted value between the 50 and 20 moving average, and it also shows us a histogram which provides information where moving averages starting to converge or diverge. So while we have all this information, we can start looking for opportunities when the market is either on the top or at the bottom of the range. The very first interesting opportunity has arisen right there when we had a bullish divergence, which means that the price has produced a new lower low, but the MACD produced a new higher low. In many cases, this indicates that the price has bottomed out. But at the same time, if there would have been a break below this low, this might imply that the trend is likely to continue. And we have multiple scenarios of the bullish and bearish divergence. For example, here is the bearish divergence, when the MACD produced a higher high and then a lower high, but the price did quite an opposite. And after formation of the divergence, we can see how price reacted. In most of these cases, straight after the divergence, price did go in an opposite direction. But to find the divergence, we might be looking for more confirmations. And on this chart, we have seen that confirmation as well on the histogram. So not only MACD can print a bullish or bearish divergence, we can also use the MACD histogram. So double bullish divergence indicating on the strength of the potential reversal. And in fact, price never went below this level, even after forming a bearish divergence. We all probably know that there are some patterns while using moving averages, such as golden cross and death cross. It would look something similar to this one, but these are different values because here we have 20 and 50 period moving averages, and for the death cross or golden cross we had to use 50 and 200 moving averages. While it might seem like a very useful indication of a change in trend, we must understand that this is a lagging indicator, and very often we have multiple crosses, death crosses, golden crosses, and it really does not help in trading. So another very useful way of using moving averages is to use them for spotting support and resistance levels. In this example, we have 20 and 50 moving average. And as we can see, we had a bounce first of the 20 moving average, and then we had a bounce of a 50 moving average. Then again, we had a case with a bounce of 20 moving average. The next bounce was with the bounce of the 50 moving average. And if we look what has happened to these price areas, we can see that they acted as either support or resistance. I do like this case right there because first we had the bounce of the 20 moving average and then bounce of the 50 moving average. And while we had these bounces, there was no daily break and close below this low. Price produced spike, but then there was no closing below the spike. This indicates on the importance of this level. And these double bounces, similar to the double bullish divergence we had, should be treated with extreme respect. And finally, wanted to share with you this example where we have plotted a 20 simple moving average. And what I look in these cases is these clean bounces, because we can see sometimes price can be bouncing and producing spikes above or below, right? In this case, and also this case, and there was another one. Sometimes we have these very clean rejections of the moving averages. And I do like to see these clean bounces. Very often what we would see is this bounce and then price range and continues to go up. And therefore some filters to use is also important. Like the first filter, obviously we need to produce a new lower low, and only then the probability of further decline will increase. Not only that, we can also use an angle of the moving average. Like we can see that the moving average here is quite flat. It's not moving up or down, but it's just moving sideways. But in this case, we can clearly see that the moving average is moving down, and this confirms the validity of a downtrend. Another filter, very common indicator as well, Fibonacci. So these bounces can be confirmed with the Fibonacci retracement indicator. As an example, we have applied Fibs to this last wave down, and what we can see is the clean rejection of the 88.6 Fibs, after which we had yet another strong wave down. And confirmation here is obviously a break below the previously made low, after which we had this move to the downside. So we can either use an angle of a moving average, and also we can use other indicators. On this chart, we have a momentum indicator, just showing you how strong is the momentum. All in all, moving averages are great tools, but we must not forget they are lagging indicators, and to make them work at their best, we might need to consider using filters such as other indicators. And that was all for today, ladies and gentlemen. Don't forget to take it easy and smooth, and see you next time.